This episode is brought to you by Indeed. When your computer breaks, you don't wait for it to magically start working again. You fix the problem. So why wait to hire the people your company desperately needs? Use Indeed sponsored jobs to hire top talent fast. And even better, you only pay for results. There's no need to wait. Speed up your hiring with a $75 sponsored job credit at Indeed.com/podcast. Terms and conditions apply.
Reality radio for a really great future. We're talking real money.
You know, in the old days, we used to call these radio shows. Today, they're podcasts because you're potting them into your ears. Hi, everybody. I'm Don McDonald, and one of the things I've always liked about doing some sort of a podcast, is the ability to interact with you, to answer questions. Some podcasts do it once in a blue moon. They say, oh, it's the Ask Me Anything time. But you know what? You're the most important part of the show to me. That's why I love Fridays, when I get to answer your questions that you have spoken at talkingrealmoney.com on the contact form. You just recorded it through your mic, like this one, on your phone or your computer or whatever it is, and then I try to answer them as best I am able in this particular format. So that's what we're doing today. It's Friday. It's Q&A day, and we've got 5 lined up for you today. The first one starts now.
Hi, Don, Tom. This is Mike in Florida. Got a question for you two. I have a friend who was pitched an annuity for $71,000 of her money, and it would produce $441 per month for 13 years guaranteed if she passed before that, but it would also go along as long as she lives, say to 100. I know that you all recommend that you can do as well outside of an annuity by investing it properly. Could you give us a scenario where the $71,000 invested in a hypothetical portfolio would generate $441 for my friend? Thank you.
I absolutely can do that. As a matter of fact, here's an interesting scenario. If let's use that guaranteed period, that 13 years. If they pay out somebody over the 13 years, they're going to pay out less than she put in, $68,000 over that 13-year period. If she was to die right away, then her estate would get $441 a month for 13 years, which is about $68,000. However, let's say she took that $71,000 and she invested it in just treasuries out 13 years, a ladder of treasuries at about 4% per year, roughly. We're going to use 4%. The money earning just 4%, very safe, would last 20 years. So she could pay somebody for 20 years on that money. Now, if she was able to invest it in like a very conservative, balanced portfolio that earned, I don't know, let's say 6% per year. Now, that money would last about 27 years. 27 years. Do you see what I'm getting at here? The insurance company's not making any kind of a deal. You've got to live for a very long time before you start making any money net to you on an immediate annuity. Yeah, it's certain, but you know what? So is the income from Treasury notes and bills. So it's not a good deal. It's great for the insurance company. Think about it. And how long is she likely to live from here? Is it likely to be more than 27 years? No, probably not. I mean, likely. Could it happen? Sure. It's not likely. Anyway, no, annuities are rarely a good deal. They just feel good, but they're not great. They're never great investments. I can't think of a time when an annuity is a great investment. Thanks for your question. Now, here's another that came in through talkingrealmoney.com.
Hello, Don and Tom. My name is George. I'm from Massachusetts. I appreciate all the help you give us. And I especially like it when you and Don and Tom disagree on something a little bit, because I can see your brains working and that helps me think better. My question is about an HSA. I'm 61 years old. I have $100,000 in an HSA. My accountant thinks that's too much money. I like it because of the triple tax savings, but she said that after you pay ordinary income taxes versus capital gains taxes, if it was in a brokerage account, you will net more money. And there's that 20% penalty before age 65. But if I wait till I'm 65 to take any non-qualified expense, the scenario changes a bit. If I take $9,000 and put in HSA for 10 years at 7%, and then I pay regular income taxes on it, yes, I make less than if I put it into a brokerage account. But if I take the tax savings of $2,160 in my case on $9,000 and I invest that in a brokerage account alongside the $9,000 in the HSA, and I pay the regular income tax on the HSA and I pay the capital gains tax on the brokerage account, I actually come up $2,000 ahead than if I just went into the brokerage account. I don't know if I'm missing something, because it seems worthwhile to spend a few minutes shuffling some things around to net $2,000 on $9,000 over 10 years. Any ideas, any thoughts on this? I appreciate all your help. Thank you.
No, you're right. You've done it right. I think your accountant has kind of taken a lazy approach, and I wonder if maybe your accountant doesn't have another reason for that. But I don't know. I have no idea. But anytime you're dealing with a pre-tax retirement account, it's wise to factor in the investing the money that you saved on taxes, as you've done. And you're right. If you invest all of it, then you have that other money that's earning money and doesn't have to have taxes paid on it, except for possibly capital gains. So you could end up being money ahead. I don't think you're doing anything wrong, in other words. I think you're doing something that's probably pretty right. Thanks for the question. Here's the next one.
Hi, Don. I have a question about municipal bonds in a portfolio. About 35% of my portfolio is in bonds. And my advisor is advising that all of them would stay in municipal bonds for the tax implications. Now, I know that's an issue that I'm not diversified correctly. And that seems to be more risk to me. But I'm also wondering about just the mathematical. Is there any way to mathematically check and see, based on let's say a fixed rate of return, that the tax implications of a 24% tax bracket would override the lower yields that municipals give? So I know that, again, I'm not diversified, as there's more risk there. But I'd like to know just the mathematical parts of it to see if there's somehow I can prove the premise or not. Thanks.
Sure. Math will prove your premise. I mean, here's the deal. A municipal bond fund, apples to apples funds, and the example I use a lot is comparing the Vanguard tax-exempt bond ETF, which is VTEB, to BND. They're of similar duration. BND, the taxable bond fund, a little bit more conservative, just a little, but not a lot. They're really well diversified in both cases. Currently, as of this recording, the BND, the taxable bond fund, earns just under 4.5%. The tax-free bond fund earns just under 3.5%, which means your break-even bracket is 24%. Basically, on incomes for singles of $100,000 to about $200,000. For married couples, it's $200,000 to almost $400,000. That's where your break-even point is. That's where the two earn about the same on an after-tax basis. So for anybody in the 32+% brackets, that's where municipal bonds start to look really good. So a married couple earning more than $380,000 a year is going to be way ahead, fraction of a fraction of a percentage point, but still ahead by choosing to invest in the tax-exempt bond fund. And if you use total market bond funds like these from Vanguard, which are both great choices, then you're getting very, very high quality across the board. Sure, there will always be some volatility in any portfolio, but the default risk is practically non-existent in either of them because they're both heavy, 100% investment grade. I mean, as close to it as you can get. So the break-even point's about that 24% bracket. Anything, if you're in a bracket below 24, then the taxable fund is better. If you're 24 plus, then the tax-exempt is better. Thanks for the question. And now we have another one.
Hi, Tom and Don. This is Dave from Smyrna. Been listening to you guys for a while. Really enjoy your content, and I recommend you to all of my friends. I sent you a written request a couple of weeks ago asking a question and realized that what I asked was not correct. And I also realized that you prefer a spoken request. So here goes. I retired last September. My wife and I used to have an annual income of about $200,000. This year we expect it to be about $72,000, and we want to be able to take advantage of some taxes this year. The income will be $13,000 in my wife's Social Security, about $15,000 in interest, and about $44,000 for my wife. She is still working. So total income of about $72,000. We take $30,000 roughly for the standard deduction. That puts our taxable income at $42,000 for this year. In the 10% and 12% tax brackets, that total tax would be about $4,600. The question then becomes, do I do a Roth conversion or do I sell some assets and pay tax on long-term capital gains? I have approximately $68,000 in long-term capital gains that I actually did sell. And I'm thinking the way it's going to work is from $42,000 up to about $97,000. That's $55,000 worth of the gains. We'll pay 0% long-term capital gains tax. And then the remaining $13,000 will pay the 15% long-term capital gains rate for a total of $1,950. So total tax estimate for this year is $6,500 roughly. I'm thinking that's our best approach for this year and just wanted to get feedback from you guys if I'm thinking correctly. Thanks.
Yeah, I think you're thinking correctly. And the fact of the matter is the capital gain's already done. But you really shouldn't have, if your wife is working and has W-2 income, she's going to have paid enough to cover most of your tax liability. You're going to have that tiny little capital gain tax liability when you're done. So it's going to be almost non-existent. Not sure where the Roth IRA comes into play, but those aren't necessary. It's nice to have a Roth for some of the money. And that may be something you want to do next year if the income situation remains where it is, that you do some Roth conversions then, since you've got a capital gain coming up this way, then you can probably afford maybe another $2,000 in income on a Roth conversion next year and just kind of spread it out so that the tax hit isn't particularly painful. But no, your thinking seems perfectly reasonable. And thanks so much for your question. And I think we did answer your written one. I'm not sure. I'm not 100%, but I seem to remember that. But I hope this answer helped. Now, I think this is our last question for today.
Hello, Tom and Don. This is Teresa from Virginia. First off, I wanted to do a little Don Stinks thing like Clark Howard does. Not really. But you forgot in talking about the ways to access your podcast, you forgot about Bluetooth. I have hearing aids and I use my Bluetooth to hear the podcast if I can't access it any other way. Also, there's a new podcast feed called Overcast, which I use because I find that Don has this big booming voice and Tom has a little softer voice and it levels out the sound. And you can look into that. It's really good.
Oh, okay. I will. Sounds good. And, you can just go ahead and say, Don, you have a big booming voice and Tom has a whiny voice. It's okay. Oh, wait, never mind. Don't say that because I think he's going to listen. Tom, you have a lovely voice. It's a lovely speaking voice, and Don's is so much more annoying. Thanks for it not really being a stinky thing, because Bluetooth is not a way people can generally listen, because you have to have a device that transmits the Bluetooth signal to your hearing aids or your wireless earphones or earbuds. Bluetooth is just a short-term transmission method between your phone and your hearing aids or your earphones. And the other service, I'll look into. We spend big money to get a service to supposedly level everything out. In fact, it's even being leveled out before it gets leveled out. But sorry if there's a difference, but I'm glad you found a service that works. Now let's get to your question.
My husband got laid off about 7 weeks ago, not related to Doge at all, but another company from another state. And we're not sure that the company is going to remain solvent. So we just did a rollover from his 401k into his IRA. And so we have about $320,000 now, but 130 of that Fidelity put into a cash account, which a money market, so it's earning 4%. But in looking at the rest of the items that I have a hodgepodgeistic portfolio for him, and so I'm leery of transferring the money into various accounts right now without your help. I had one specific question related to the AVUV and the ones that have small cap. And I had heard Christine Benz recently say that as you get older, you should move away from small cap. Is that correct? I don't hear you guys talk about that. I'm 75 almost, and my husband's 70. He is looking for another job, which would help us to put more into a 401k or retirement. But as of now, all we have is Social Security and his military pension. So help. Thank you. Bye.
Thank you. This just illustrates so many of the problems with financial media and our need to speak generally. Yes, small cap stocks are more volatile than larger company stocks, generally speaking, over time. Not always, but they have been. And so conventional wisdom would say, no, have less. Well, we're not proponents of conventional wisdom. And we're also not proponents of buying things just because somebody, including us, says it's a good thing. When we say AVUV is a good small cap value fund, or we believe it is, we're saying that in a vacuum. It really shouldn't be something you or anyone else buys just because we mentioned the name. You only buy it if it fits your portfolio, if it makes sense. And it makes sense as a long-term, permanent part of the portion of your portfolio that you can comfortably invest in equities. For example, let's say you're a 50-50 stock-to-bond investor based on your risk, needs, and tolerance. Well, of the 50 in stocks, you should probably have no more than 20% of that in a small cap value like AVUV, which means out of that 50,000, that's no more than 10,000 in an AVUV. The other money needs to be spread between larger company funds, U.S. funds, and international funds. And if you're really going to build the right portfolio, then you should have a portion in emerging markets. You should have a portion in large cap value on the stock side. And then the bond side should be high quality bonds or CD ladders or bond funds for the other 50%. So the stock portion should always be properly allocated and remain properly allocated through a process of rebalancing regularly. So if the small cap value did really well, you don't want that to go to 30 or 40% of the portfolio. You want to trim it back and sell some of those shares and buy shares in the large cap portion of the portfolio. But it sounds like you need a bit of a portfolio overhaul because you've got bits and pieces, and you've done what most people do. They invest in things. They don't build a portfolio that's the right portfolio for them. They invest in what they hear somebody talking about. And that is the biggest disservice that we in the financial media do, is even mentioning. And we do it too. We shouldn't, but we almost are forced to. You know, what's a good fund for small cap value? AVUV, we'll say, for example. What's a good international equity fund? DFAW or AVGE, we'll say. But that doesn't mean we want you to go out and buy those. They need to be part of an overall planned portfolio. And that is something that does not lend itself well to the shortness of a podcast. If we, maybe, I'm not sure. Maybe there's some value someday in sitting down with somebody and just doing a complete portfolio overhaul. But again, it's so personalized, that's going to be relative to that person and not to all the listeners. So I don't know what the correct answer is, except so many need at least a financial plan from a really good 100% always acting in your best interest fiduciary advisor or financial planner, not somebody who sells product on commission. Always ask that question, by the way, of anybody you deal with. Do you ever receive any commission for any products that you put your clients in? Ever? If they say yes, look elsewhere. Well, I think that brings us to the end of another exciting Q&A episode. Thanks for being a part of it. If you want to send your Q's in for me to A, then go to talkingrealmoney.com, click Contact Us, and then record your question. If you'd like to talk with us live so we can have a little back and forth, Saturday is the day to do that. It's the only day we actually talk with people when we do a radio show that becomes a podcast. And you can call us from 3 p.m. to 5 p.m. Eastern Time. Just write that down in your calendar, 3 to 5 Eastern, and then the number 855-935-TALK, 855-935-8255. By the way, the closer you call to 3 to 4, the more likely we'll have time to get you in. Although most of the time we can get a lot of people in. It's 2 hours. So call during that period if you want to get your questions answered and actually talk with us. Thanks for listening. Tell friends, please. Tell everybody, even enemies, please. And visit us often at talkingrealmoney.com and come back almost every day on your podcast service that you're using right there as we're talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.